Hello and welcome back, guys. So in this particular session, what we will be covering about is consolidated statement of financial positions, MCQs, multiple choice questions. Okay, so I have a set of questions over here, 10 questions. We will try and solve this. Hopefully, we get it right. And then after that, let's look at it, and then this should give us a bit of clarity when we learned about financial position and then how do you account for it. So we have already covered associates is already done in groups, in consolidation, and then in consolidation of financial position is also done. So next we'll be talking about consolidation of SOPL. Okay, so profit or loss consolidation, we'll be talking about that. And then we will also talk about group disposal, acquisition, all that thing will also come. We have not talked about that yet, so we'll talk about that as well in a great detail. And then after that we'll also talk about cash flows, and then after that group foreign currency reserve as well in case of group, so which is a SPR's content, but I'll still give you a bit of idea in this. So let's look at our problems. Okay, so LPD buys goods from its 75% owned subsidiary QPR. So subsidiary is QPR, owning structure is 75%. So QPR earns a markup of 25% on such transaction. Okay, at the year end 30th June 20x1, LPD had not yet taken the delivery of goods at a sales value of 100,000. So LPD bought from its own subsidiary. That means what has happened, it's a goods in transit, right? Has not yet taken the delivery of the goods. That means when we are preparing our consolidated financial statement, what we normally do is that we assume that the goods has been received. Okay, so let's calculate the PURP first of all. So how much profit margin was there? Let's calculate that first of all. So cost, I'll just use my standard template when I'm calculating my PURP. So I like to have a big detail in my thing, in my calculations. So 100,000. That's why I'm writing all these things. Total sales, right? And then after that, what was the cost? This figure divided by. So since this is 125 percentage, right? Because it's a markup of 25%, right? That's what the question says. Markup of 25%. So what we'll need to do is that into 100. Why I'm not doing 25? If I wanted just a profit, I can do 25. That's the profit. But I need the 100% of it, right? So what was the cost? So after this, what I can do is that I'll show you another way. Let's do this way. So divide by 125 into, if you do 100, you get the cost, and then 25 is your profit, right? It's already included within that figure. So see, this is how you get 20,000, and if you subtract this from this, that will also give you 20,000. Okay, so it just depends which way you find it easier. So you can basically compute it from this selling figure itself, but I like to, what I normally do is that I put the cost in the side and then selling price, and then after that I know, like, okay, this is the cost, this is the selling price, this is the profit, so this is what it should be, right? So while looking at this two figure, I know that it will be 20,000, right? So sometimes you might make a mistake, like it's you might do like into 100 or whatever, like there might be a mistake, so it's pretty easy to identify. That's why I do it. Okay, so inventory that the parent should receive is of 80,000, right? So what we will need to do is that we'll need to add that particular inventory. So what would be a net increase in inventory in the consolidated statements of financial position of LPD group, right? So that is, how much will it be? 80,000, not 20,000. If they had said a PURP, then we would say it's 20,000, but they have asked for this figure, right? So it's 80,000. Okay, so that's been solved. So let's look at second question then. So STV owns 80% of the ordinary share capital of subsidiary, which is TUW. Okay, at the group's year end 29th February 20x1. Okay, so STB payables includes 3600 in respect of inventory sold by TUV. So parent owes 3600 to the subsidiary, right? So TUW receivables include 6700 in respect of the inventory sold to STV. 2 days before the year end, STV sent a payment of 3100, right? So to TW, with that was not recorded by latter until 2 days after the year end. Okay, so the parent has already sent a payment of 3100. So it had a receivable of 6700. That means this amount should be removed as well. Okay, so what should happen is that this amount should be added to cash, and then after that from the receivable, what you will do is that you will deduct the same amount. Okay, because we eliminate intergroup transactions, right? So what we normally do is that 6700 minus 3100 minus 3600, and then from the payables as well you remove this 3600 from the parents thing as well. So what I'll do is let's show you over here so that it's easier. So receivables, so you have a receivables, you have a cash, and then after that this side I'll just make payables. Okay, so what you will normally have is that, so payables would be 3600, and then see it's a goods in transit, right? And then after that what you need to do is that, so the receivable was 6700, right? 6700. So why is it that this payable has decreased? Do you know that? Because what this particular parent has already done is that it has already debited payables and then credited cash, because it's already paid from his perspective, right? So whereas in this case it has not yet received that particular cash. Okay, so before it was being paid, the payables would have been how much? So it is 6700 still, because it's not yet received over here, but this particular company has already done the entry, that's why it's not being eliminated. Okay, so what would normally happen is that, so what you would normally do is that you would deduct how much cash payment that you received. So how much did you receive? So sent a payment of 3100, right? So 3100 would be removed, and then after that 3600 also would be removed, because that's a group intergroup transaction, right? And then after that from here how much would be reduced is that you would add 3100 in cash. You assume that the payment made by the parent is already received. Okay, so in payables case as well it's the same thing. You would eliminate both of them. Okay, so you basically have a zero payables over here. So basically all you need to do is that cash. Okay, so cash you should add 3100 and then reduce receivable by 3100 as well. But what does the question ask? What is the entry that should be made to remove the intragroup transaction from the group accounts? 2325 to be added to cash? No, that's not the payment that we made. So 3100 added to payables? No, because you don't add anything in payables. 3100 added to inventory? No. 3100 to be added to cash. Okay, this is the answer. Okay, so I'll just bold 3100 should be added to cash. Okay, so that's the thing. And then after that, let's look at the next question. So where the purchase price of an acquisition is less than the aggregate fair value of the net assets, which one of the following accounting treatment of the differences is required by IFRS 3 business combination? So they are talking about negative goodwill, or you could say capital reserve, but negative goodwill is the appropriate word that IFRS 3 talks about. Okay, so what you would do is that, so in this case, so basically you would have actually charged it directly to SOPL. Okay, so let's see our options. What is there? Deduction from goodwill in consolidated statements of financial position. Why would he do that? Because it's not impairment. So immediately recognize as gain or loss, gain in the changes in equity. No, not over there. SOPL, remember. So recognition in statement of comprehensive income over his useful life. No way, that's not really how you do it. So immediate recognition as gain in profit or loss. Okay, so this is our option. So this is the only valid reason that it seems to match. Okay, so after that, so on 20th September 20x1, GHI purchased 100% of ordinary share capital of JKL for 1.8 million. The book value of the JKL's net assets at the acquisition date was 1.3 million. The valuation exercise showed that the fair value of this was 100,000 greater than its book value, and JKL immediately incorporated this valuation into its books. Okay, so what we need to do is that uh, calculation of net assets, calculation of net assets, right? So what we've been given is that, so we know the net assets already, right? So net assets at acquisition at reporting. Okay. So what's our net assets? Mm, Net assets at acquisition was 1.35 million, right? So this is figures in million. Okay, so 1.5, so it's 1.35, and then after that 100,000 divided by 1, 2, 3, 4, 5. So that's our fair value adjustment, right? So the question has not given us what was it at the reporting date. So there must be, if there is a fair value adjustment, there must be excess depreciation as well. But what we are required to calculate is that calculation of goodwill. Okay, so for goodwill we don't need that, right? Because we know calculation of goodwill is done by cost, fair value of NCI, and then subtract less net assets, at acquisition, right? So what's our cost? Our cost is 1.8, so it's 100% owned subsidiary. So 1.8, so fair value will be 0. So when you add this plus this figure, you would get 1.8. So after that, you can just link it from here, and then we need to add this figure up. So this figure plus this figure will give us our net assets, and then this will be our total goodwill. Okay, so this will be this figure minus our net assets at acquisition, right? So 0.35 million. Okay, so that's basically our goodwill on acquisition. Okay, so 0.35 million. Okay, so that's our answer. So yeah, otherwise, like if we don't need anything else if we add, because we don't need the reporting dates figures for calculation of goodwill. Okay, so let's solve another question. So Paul acquired 75% of the share capital of Simon on 1st Jan 20x1. On this date, the net assets of Simon were 80,000. The non-controlling interest using fair value was 40,000. On Jan 1st, the net assets were this much, and then goodwill was impaired by this much. What was the value of non-controlling interest? Okay, so in this particular case, what we will do is that let's create our standard format. Working note 1. Structure. Parent. Okay. Calculation. Net assets of subsidiary. Acquisition at the reporting date, right? So let's bold it. Nice. And then share capital. So we don't have share capital, I think, in this. So what we have is net assets is already given, okay? So what's our net assets at acquisition? So our net assets at acquisition was 80,000, right? So 80,000, and then on Jan 1st 20x3 it was this figure, right? So 120. So 80 and 120, right? So 80,000, 80,000, 120,000. And what's our group structure? We missed that one. 75 and 25, right? So 75 and 25. And after that, our post acquisition profit is acquisition profit would be this figure minus this figure, right? So after that, let's calculate the goodwill. Calculation of goodwill. So cost, the value of NCI less net assets at acquisition at ACQ. Goodwill at acquisition. So what's our cost? How much did we pay? Does it say anything about that? So it does not say anything about that. It just says it acquires. That's pretty much it. It does not say anything about goodwill. So how do we solve it? We can still solve it because say you don't need that value anyway. So giving it all blank, what I'll do is calculate fair value of NCI. Calculation of NCI, right? So first thing first, what we normally do is that fair value of NCI, right? Less impairment and then goodwill, right? So fair value of NCI is already given. What is given? 40,000, right? 40,000. So same figure over here as well. 40,000, but we don't know anything else, right? This plus this, and then this is basically this figure, right? So it's not gonna work that way, I know that. And then it's normally this figure minus this figure, and then it's this figure plus this figure, right? So since we don't know the cost, so we can't calculate it, but we can use something else. Share of post acquisition profit, right? So how much is this particular company getting? So this is our post acquisition profit into 25%, right? So that's the profit they are getting, and then there is a impairment of goodwill, right? Goodwill. So how much is it? This impairment figure into this figure, right? So our total NCI would be sum of everything, right? 7,500. Okay, so this is our figure. So see, we don't need the cost of investment to calculate NCI. Okay, so I knew that in back in my head, so that's what I was trying to show it to you. Okay, so all you need is that fair value of NCI, and then your post acquisition profit, and then if there is any goodwill impairment or PURP, you just need that information. That should be enough to calculate it. Okay, so let's 47,500. Okay, so B number, that's our option, right? Let's highlight it. Then so Peter acquired 90% of share capital of Shawl at 1st Jan 20x2. Okay, so 1 year, and then 2 year, and then third year, or 1 year, 2 year, third year. That's all, third year, I think. Okay, so goodwill was impaired by this, net assets were this, goodwill was correctly valued, return earning was this. So we need to calculate total group retained earning. Okay, so let's do it. So Sol's net assets were 100,000, goodwill was correctly calculated at 30,000, and then at 1st Jan 2006 the net assets was this much, goodwill was impaired by this much. At the same date, return earning were 70,000. Okay, so let's do it. So same thing, let's just change the values. 10, so net assets at acquisition date was, how much is it? 100,000. The later on date, it was the net assets of at 1st Jan 2006. The net assets returning was, okay, so 140. Okay, so we need that figure for 100% of, that's the parent's profit. Okay, so that's not about this. So how much did he pay? Does it say anything about goodwill? Does not say anything about cost or anything of that sort, so we don't need to worry about that. We don't need to worry about this as well, but we know goodwill is 20,000. Okay, so even though we don't have the calculating figures of at up, so our goodwill is 20 or 30,000. Okay, and then it's been impaired by 20,000, so that means our carrying amount is only, so this should be this figure minus our impairment, right? So 10,000 is our goodwill at acquisition. Okay, so after that, so we don't need to calculate this figure. Calculation of NCI is not needed, so that's not possible as well because we are not given any fair value of NCI. I mean fair value of NCI, yeah, that's not given. So group reserves, so how do we calculate this? Is that 100% of parent. That's why this figure is given over here. See, Peter's return earning. So that Peter is the parent, right? So its return earning is 70,000. That's why the figure is given, because we need it over here right now. So after that, share of profit, share of post acquisition profit of subsidiary. Okay, of subsidiary is, what's our post acquisition profit? This figure into our percentage, parent is 90%. Okay, and then there will be a deduction of impairment for our share. Okay, so since there is an impairment of goodwill, so we need to deduct this figure into minus, so that we get it in negative, so 90% of that, and then it should be our total figure. Okay, so let's sum it up. 6,000, right? So do we have it over here? No. So what did we make mistake? So 40,000, right? Did we make any mistake? So 40,000, right? 40,000, why not? It's 40,000. Okay, acquisition. So it's 100,000 over here. So 100,000. So that's 88,000. Okay. So now our answer is correct. Okay. So total goodwill at this figure, group reserves. Okay, same thing. So Pauline acquired 60% of share of Sonia 100,000 share capital in 1st Jan 20x3 when the Sonia's return earning was 120,000. So 60%, okay. So this is changed now 60/40, and then after that, what else did it say? Share capital, right? Share of Sonia's 100,000, okay. So what we need to do is that let's move this thing a bit low. So I have not got it yet. So got share capital, and then after that, that's 100,000. Reporting date also it's same. Retain earning. Let's look at it. Retain earning. So at acquisition date, what's the retain earning at acquisition date? 120,000, right? So 120,000. Pauline paid 50,000 in cash. Also agreed to pay 90,000 in thingy on 1st Jan 20x5. Okay, so now this is interesting. So what we need to do is that, so let's delete it, and then let's move this thing down as well, because we need to add few more figures over here. So what did it pay? It paid cash. Deferred consideration, right? And there is a deferred consideration as well, and then there is some shares as well. So share has also been issued. Okay, so how much cash did it pay? 50,000, I guess. 50,000 and then 90,000 further, right? 50,000 and then 90,000 divided by 1 point. So that's after 3 years, right? That's what, isn't it? So after 2 years. So it acquired on 1st Jan 20x3. That means 1 year is gone, and then second year. So it's 2 years, and then our discounting rate is 10%. Okay. So 1.1. What I missed in this is that is equals to, so 1 to the power 2. Okay. So after that, shares. So is there a share issue as well? So Pauline also gave owners of Sonia 1 Pauline shares for every 2 Sonias purchased. Okay. So only cash consideration has been recorded by Pauline. Okay. So what will have that happen is that basically when you're uh, creating your equity section, so you need to keep that in mind as well. So you need to keep that additional share that has been given to them should be added. Okay, so 1/2 into how many shares? 100,000 shares into how much did they purchase? 60%. Okay, and then how much did they pay? How much did they pay? So on the market, it was selling for $4. So $4. So that's how much they paid. Okay, anything else? No, I think we are all good. So what about our retained earning? So it was 120. That's done. This information is also recorded. So Pauline had a retained earning of this figure, and Sonia had a at 31st December. Okay, Pauline had this. Sonia had retained earning of this. What the hell? Sonia had written earning of this, so I think this must be a mistake. So this is what it should have been. So I guess so. Let's remove this part 210 and then let's consider Sonia's return earning to be 110,000. Okay, so 110,000. So has there been any fair value adjustment? Nope. So what we need to do is let's total it up. Bold it. Sum. Forgive me, I have not gone step by step in this particular problem. So this figure minus this figure, because I just saw the other thing like about all this cash and everything, so I just went with the question, so I forgot this particular how step of a way of doing it. Okay, so don't worry about that, should be all good. So after that, fair value of NCI, 25,000. So this figure should be sum of everything, right? All this above things. And then after that, this is our net assets at acquisition, which is this figure. Then this should be our differential. But what has happened? So it's this figure minus this figure. Right. And then after that, so that's our goodwill at acquisition. And then aren't we required to get the goodwill only? Yeah, total goodwill. That's what we've been asked, isn't it? 29,380. Now there has not been any impairment. It's 49,380. 49,380. Okay, that's our answer. So let's remove this part. So our goodwill has not been impaired, so we don't need to worry about that, right? So after that, group retained earning. Okay. So working note 4 would be normally calculation of calculation of calculation of NCI, but we need group reserves, so we will be doing it. Okay, group reserves. So 100% of parent share of post acquisition profit. So what's the parent's profit? This we've been given away 210, right? Pauline had a return earning of 210. So 2,10,000 is Pauline's, and then after that, our post acquisition profit is this differential into our percentage holding, right? So 6,000 is in negative. Okay, so anything else, is there any impairment or anything of that sort that would actually reduce our group reserves? I think there is something. I think there is something. I think there is something unwinding cost that's there, which is basically this deferred considerations payment. Okay, so that's what will reduce our retained earning. So less unwinding cost. Okay, will be, and then after that what would happen is that this figure into 10 is for only 1 year, right? So what I could do is that I could use this technique. So this figure into 10%. So what I could do is that this is the figure uh, into 1.1 to the power, right? So 90,000. So 90,000 minus this figure. So 90,000 minus this figure, because at the end of the period we will be paying that figure, right? So this should be our unwinding cost. So basically happens that this should be in minus. Let's change the signs so that we get it in negative. Okay, so hold it, and then after that our total should be sum of all this 188 380. Why is it not there? What did we miss? Retained earning, right? So Pauline had a retained earning of 120, and then after that the retained earning has improved to, no, decreased by 110, right? And then after that the cost of capital is 10,000. So it's saying at 31st December. Okay, so it's not after 2 years, so it's only for 1 year. Okay, so that's easy. That's basically just this figure into 10%. How how much it should be reduced by. Okay, so 196 561, 196 561, this is the figure. And then after that let's look at the other question. So what does it say in this? So the following extracts of SOFP are provided for PNS for the at 31st December 20x4. Okay, and then receivable is for P is this, S is this, payables is this plus this, and then at 31st December 20x4 P owed 10,000 to S, so that means it's in payables. So this did not agree to receivables in S due to a check paid by P at the year end which S did not receive, so it's a cash in transit. So select the correct amounts for total receivables and payables in the consolidated statements of financial position as at 31st December 20x4. Answers need not to be selected from same row. Okay, so what should happen is that basically, so 6,000 has already been paid, right? So 10,000 is removed from payables, and then after that from payables 10,000 is removed. So I think this will be this figure, so I'll just bold it. And then after that, so what would normally happen is that I'll just show it to you so that it's easier. So payables, right? So payables is 60 plus 30, 60 plus, and then after that payables is there, receivables, and then you have your cash, right? So what you would normally do is that receivable is 100 plus 80 minus plus 80 minus, so how much did you receive the cash for? 6,000, right? So 6,000 is our thingy. 6,000 is the cash that we receive, so that will decrease our receivable, but it will increase our cash. Okay, so we need to worry about that as well. And then there has been a net effect of 4,000 as well, so that's the mutual owing. Okay, so in this particular figure, what we need to do is that, so we need to reduce it by 10. Okay, because 6 we have already paid, 4 is the mutual owing, or that's the payable to our own subsidiary, so we eliminate it. So, and that's for the payables, right? So in this case as well, it's same thing. So I should have done it in thousands. So it should be 6 only, right? 6 minus 4, right? That's what it should be. So receivable should be 170. So because it's figures in thousands, and then this 6,000, 4,000. Okay, that's good. So in cash, what you normally do is that you add 6. Okay, so I don't have the cash figure right now. What you normally do is you reduce it from receivables and you add it in cash. Okay, that's pretty much what you normally do. Okay, so receivable is 7,170, and then after that your payables is 80. No, 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 wait. So there has not been a net effect of 10 itself. Let's see. Mean, I missed it again. So this is minus 10. Okay, so see how this is minus 10, this is minus 10, crosses out, and then after that this 6 is adjusted over here. Okay, so that's how you basically do it, because 10,000 was a receivable of ours itself, right? So that's why we reduced it. Okay, so that's done. 164 and 80. So see how it's in different, like it does not need to be from same row. That's why the question says that. Okay, so P transferred an item of plant to S on 1st Jan 20x3 for 30,000. The plant had a original cost of 30,000 at 1st Jan 20x1. Okay, and had a useful life of 10 years, which is unchanged. What is the unrealized profit at 31st December 20x3? So its cost was 30,000 at 1st Jan. So it's been used for 1 year, 2 year, right? So how much will be the depreciation for 2 years? So plant 30,000, and then after that depreciation would be this divided by 10 into 2. So this minus this, what its carrying amount should have been, but its sales price is what it did sell for, transfer an item to for 30,000, right? So it sold it for 30,000. So 30,000. So now what would happen is that this figure divide by, since 2 years is already gone, so divide by 8, and then is what our carrying amount should have been, this figure minus this figure. So this is at 1st Jan 0x1. Okay, this is 1st Jan, and then this is 31st 12 0x1. Okay, or x3, I guess 3. 3, and then when it is sold at higher price, so that's the cost for the other company. And then after that, what it would basically do is that it would do the same thing, but the depreciation would be of higher amount. Okay, and the carrying amount that will be recorded in its books of account will be 26,250. Okay, so the PURP will be this figure minus this figure. Okay, 5250. Okay, so this is your PURP. But when you're preparing your consolidated financial statement, you will have to break this figure up into two different part. Okay, what you need to do is that, see, original realized profit is actually this figure minus this figure. But what has happened is that due to excess depreciation, your profit has gone down, right? So excess depreciation, because the cost for that particular company has increased, right? So the depreciation should have been 3,000, but now it is 3,750. So it's gone up by 750, right? So this figure minus this figure. So that's how you basically get this figure, okay, your PURP. So if you subtract 6,000 minus 750, you will get 5250. Okay, so basically what you will do is that this figure you will take it to reserves, group, return earning, and then after that, this depreciation, what you will do is that you will reduce from net assets of subsidiary. Okay, that's what you will basically do. So you need to split this figure up, okay, so that it's easier to reconcile. Okay, so that's pretty much it. What's our unrealized profit? 5250. 5250. So let's check our answer. 50, 164.80, right? And then after that, 8C, 8C, okay, and then 7A, 7A, 6C, okay, and then B, 6C, and then B, and then 350,000. So that should be our 0.35. So into 10 million, into 10 million, or into 1 million, I mean. So it should be 350. Okay, and then immediate recognition at gain or loss in profit or loss. So that's what seems logical. So D, yeah. And then for this as well, 3,100 to be added to cash, no doubt about that. And then net increase in inventory, 80,000. So 80,000 increase. Okay, so this is basically how you solve this problem. So this has basically given us a detailed picture of about intragroup transactions, and then PURPs in case of plant or goods, cash in transit, goods in transit, and then after that, basically how to calculate your goodwill and your retained earning, everything. Okay, so it has basically given us a strong concept of preparing consolidated financial statements. Okay, financial position. So nextly we'll look at SOPL, and that should finish our consolidated financial statement for the time being. Okay, that's all for today, guys. If you have any other questions, please do comment down below. Until next time, bye bye.